It's not very often you see such an interesting 48 hours in the market. Markets around the world were up and yields were also up. From AI hype FOMO to hot employment data, one thing we can say for sure is the US labor market is extremely resilient. Unemployment down and consumer sentiment up, reaching multi-month highs as inflation fears all but vanish. And it seems the path of least resistance now is higher. We also need to talk about next week. Next week is Opex. And with trillions of dollars of gamma expiring, the market will finally be able to make its move. Will we go ahead and hit all-time highs? Let's talk about it. Hello, ladies and gentlemen. Welcome to the Daily Recap Show, where we talk about stocks and the financial markets. If you like this video, please subscribe, hit the notification bell. Let's get into it. Hello, everybody, and apologies for getting this video out late. I'm feeling under the weather, so if my voice goes, I apologize. But we had a very, very interesting day. Consumer defensives, the worst performing sector. It's green pretty much everywhere. Technology, oil outperformed, doing really, really well. Same with industrials. Regional banks just keep on chugging along, and healthcare as well. I mean, just green everywhere. Really, really good. But have a look at this right here. Lulu, 5.37%. We thought the earnings weren't that good yesterday. Turns out it was actually sell the rumor by the news. And the S&P 500 put up strong days back to back, just as more people went bearish. And in the new sentiment survey, bears ticked up from nearly 20% all the way to 27%. A huge increase. And a lot of them coming from these people who were in the center. So these people took sides either here, a little bit less here, but a lot of people went bearish this week. Here are the majors and the best performing sectors here: small cap value, small cap growth. The best performers today, the IWM significantly outperforming the S&P 500 and the Nasdaq, and the jobs numbers today came in hotter than expected. We're going to do a deep dive into them a little later. Now, what we can expect for early November into December is sort of just this movement right here before we make a dip anywhere from the 7th to the 14th. I've shown you guys this ad nauseum, but I think it's very important for you guys to understand the seasonals, especially when we've been up more than 10% in the year. This is the type of price action we can look for, and anytime between now, this week, and the week after, we can expect some form of a rally. And you know what? I'm going to show you in the charts a little later. We may have already had the bottom for the Russell 2000. Even for the SPX as well, you could see this is the dip we made right here. This is the December seasonal chart. This is what we're doing, and this could be the dip right here. You have to understand that seasonals are just the average, but on the average event, we normally make a dip here, and we could probably assume that because of that, there is some form of a bottom that does form in December, and this could be it, because next week is Opex, and I have some of the stats here for the Dow Jones. Now, the Dow Jones is not the S&P 500, but they are positively correlated. Generally speaking, when one up, the other is up as well. And you can see that it's quite positive on this option expiry day, data going back since 1982. And you could see here that on option expiry day, average return of 0.1%, 23 up years, 18 down years, only higher about half the time. But the actual week of Opex is actually up about 0.5%, 72% of the time. Very positive stats right there. And same too with the week after. We normally get nearly a 0.7% return 75% of the time. But we do have to take this with a bit of grain of salt, because Opex is coming significantly earlier this year. And we have some commentary from Wayne Whaley, and he says, I think you need to be careful with the equity seasonals next week. He's talking about Opex. I see S&P 500 28 and 12 in December Opex week last 40 years, but it's very early Opex this year, falling on the 15th. I also see the S&P 500 16 wins, 24 losses from Jan 8 to 15. I think he means December 8 to 15th. With the Nasdaq 14 wins, 26 losses, for an average of a 1% loss from, again, he says Jan 8 to 15, but I think he means December 8 to 15. We do need to be careful. We do need to, so just take this though, just have a look at the seasonals. Opex is coming a bit early this week, guys. I just want you guys to be aware of that. Now let's talk about NFP, and the NFP came in at 199 jobs were created. It was a hot reading. People were saying it could be inflationary. Let's dive a bit deeper into it, because you'd think a hot number would be inflationary, but if you dive into the details, it's a lot less so. NFP was a bit higher than expected, 199 versus 180 consensus. The difference, however, came from higher expected government jobs. NFP private were a tad lower than expected, 150 versus 153, and that's very important. And this took the unemployment rate all the way down to 3.7%, which is around the 2017 to 2019 average. 3.7%, the unemployment rate actually fell from 3.9% the month prior. The big reason why we didn't sell was actually because of average hourly earnings. Even though we did put jobs into the economy, wages did fall, and it's actually inside the Fed Fed's 3 to 4% wage target growth rate. And this is why the market didn't overreact, because there was no upside surprise in private NFP. It was all government jobs. Average hourly earnings were close to the Fed's, in the Fed's target range actually, and the unemployment rate fell, but wages were still in line, not inflationary, guys. And this is why the market actually liked this. We said inflation is declining, but we're still getting a resilient job market. That is super bullish. And that's why everything except 3 sectors were up today. The only 3 sectors that weren't in the green was XLU, real estate, and staples. Everything else, including the SPY, was really bid up. And have a look at regional banks, even energy, semiconductors, technology, software, financials, communication services. Everything was up except these 3 right here. And of these 3 sectors, XLU, utilities, and real estate are extremely rate sensitive. And we did see rates actually go up on day. Everything from the 2-year all the way to the 30-year were up like 5-7 basis points for the day, and futures, bond futures, was actually down a full percent. TLT holders would not be happy right now. And this just goes to show, if the market knows the Fed is winning the fight against inflation, then good news becomes good news, and rates can go up and stocks can go up. This is something we really need to take into consideration from now on, that if we get great data and it is showing that inflation is receding, that's bullish. That's super bullish. I did show you this early in the week. Corporate insiders are buying, but we're also seeing this in the S&P 500. Now, this is the Luthold indicator, and pretty much it looks at insider sales of the S&P 500. It looks at block sales. When you get to this green line, it's pretty much a buy signal saying there's not many block sales, as in sellers, coming into the market, whereas this right here, there's a ton of block sales. And normally these go on to produce extremely good long-term buy signals. The only bad one was in March 2008, but we actually got a second signal in 2008 as well. And that would have been a great signal right there long-term, there too, in early 2014, 2018. Great signals right here. So it just goes to show that insiders are selling the least amount of the S&P 500, buying technology. I showed you charts early in the week. They're selling the least amount of healthcare, utilities. So really, really good long-term buy signals. And I'm talking 2 years, 3 years, 4 years plus into the future coming into the market. And we do know that insider purchases are extremely bullish. 1 year later, you normally see a positive return of about 39.7% when insiders do purchase stocks. Just something to note there. But that doesn't mean the market is expensive. And if you have a look at the forward PE of the S&P 500, currently sitting at about 18.7, it's probably at about 18.8 right now, but the equal weight sitting at 15.3. And I think if you miss the rally, you should probably go ahead and buy the equal weight, because a 15.3 PE for the best 500 companies in America, this is a very attractive price. And look at this data from Market Desk. They actually measure the equal weight outperforming versus the market cap weighted index. And we've sort of seen a bottom here in November 2023. And could this be a rotation out of the Big 7, the Mag 7 technology into the broader market? That's what we are seeing. And I do think that the S&P 500 equal weight index is going to outperform in 2024 if we don't get a recession. What's really interesting about all of this is that if you look at the historical data, the equal weight S&P 500 tends to outperform the market cap weighted S&P 500 over the long term historically. And looking at history, you could definitely see here, this is some insights from Fundstrat. So do take into consideration, these guys are insanely bullish all the time. Stats are stats, and we do need to look at them. That after a 15% up year, stocks still gain more than 10% half of the time. The S&P 500 return more than 10%, more than 15%. 50% occurrence, 32% occurrence. And pretty much the S&P 500 is positive 71% of the time when we've had a 15% up year or more. And that's what we have right now. And here's the stats. You guys can go and have a look at them. But a recession or a soft landing could derail this, because a lot depends now on the macro picture. And here's the Fed first rate cut. Normally, if the Fed cuts rates, we get a recession. Equity markets normally go on a massive slide, nearly close to 20% declines, drawdowns, and about 10 months is where the bottom hits. But if we don't get a recession, multiples normally expand aggressively, and we do get a rise, again, upward of 10% in the S&P 500. So a lot's going to depend on next year. Do we get a recession? Do we get a soft landing? Do we get neither? A lot's going to come down to that. Enough about next year. Let's talk about next week. And we are officially in Opex week next week. We have Vixpiration. We have Expiration Friday, the big one, the December one. And VANA and charm flows are actually strongest in the second week, Opex week. And this is why we've sort of just been moving higher, is because what's been happening is that people think this rally has been super strong. We went from 4,100 all the way to 4,600 extremely quickly within 4 weeks. So what traders are doing is selling calls, betting that things will go down. Dealers are now long calls and they short the underlying stock as a hedge. And as price stays flat, they buy back the underlying because the call decays. And if the price goes down, they buy back the underlying because the calls lose value. Win-win for bulls. And it's why we just sort of go higher in positive gamma. Market makers are very supportive of this market. Dips get bought. And this is why price has been pinned between 4,500 and 4,600. But that's all changing next week. There's a ton of gamma sitting in this area right here, and a lot of it is expiring. 823 million total exposure, 300 million expiring on Friday on Opex. That's 35% of total open interest. We also had 9.2% expire today, and we do have small portions Monday, Tuesday, Wednesday, Thursday expiring, but the big one on Friday. And this is going to allow the index to move, both the S&P 500, the Nasdaq, the Russell. It's just going to give it more breathing room to move, especially as we go into the VANA and charm window of weakness. And the movement of the index could allow for a bottom in small caps. We do know that small caps tend to bottom around this time or any time between now and next week in the Russell 2000, ready for an end of year run. The same is true for the S&P 500. We do know that on the 15th, we are expecting a bottom inside this time period before we do go on an end of year absolute rally. Quickly, we could have actually already made this bottom in the Russell right here on Thursday because we are up 2% since. So this might be the December's bottom, but we could be looking for an even lower low next week. It all depends. Now let's hop on the charts. Now, this is the S&P 500 year-to-date chart, and we actually went ahead, and I said yesterday, if we go ahead and close inside this area, it's going to be insanely constructive to go ahead and make new all-time highs as we go into 2024. That's exactly what we did. At the start of the week, I said I'm very bullish on chop around this area with a bias to higher. That's exactly where we are. And if you want to know what I think is going to happen next week, stay tuned for the weekend video. I might release that sometime this weekend. So go ahead, hit the subscribe button so you don't miss that video. And this is insanely constructive price action for bulls. And this is the SPX. Let's actually go to the futures. And the ES put up an even bigger day, and it was the strongest close. Let me actually put on the price label. It was the strongest close since early 2022. We have not made a higher close, a weekly close, this high in the futures market. I mean, we rallied, we continue to rally after hours, and we pretty much closed nearly at the highs. Bears tried to take us down. Bulls stepped in. We went all the way up after the employment data, after the consumer sentiment data. And this right here, this is like January 2022, very close to December 2021. And this is insanely constructive. I do think that late December, early 2024, before the mid-January, we could go ahead and break these new all-time highs. And it's about at the 4,800 level. So still a bit of upside, I believe, guys. Now, looking at some dark pools, it doesn't show here, but this is the SPY, SPY. Saw some big trades coming here as well as a late print, but pretty much we had this volatility, made a low. As long as we stay above here, we probably just do the same next week and chug higher. But there may be a bit of volatility on Wednesday with expiration and a bit of volatility on Friday. So just be wary of that. Looking at the TLT, we saw some more big trades coming right here and right here, very big trades. And I do think that based on everything we're seeing, we can see the TLT just pull a bit back to about this level right here, 92.50, before we do go ahead and make higher price action. It's been a very good run. If you go on my Twitter, this is where I alerted you guys, 13th of November by TLT. We've had a strong 11, 12, 13% run ever since. So it is healthy for us to have a bit of a pullback. And again, as long as we stay above this level right here, even, inside this area right here, it's going to be very constructive to go ahead, make higher highs. I am bullish on bonds. I'm very bullish on bonds in 2024. You guys know this, and I've been saying it for a very long time. Now, there's also a ton of data next week, but the big one we need to be focused on, there is CPI, there is PPI, inflation data, as well as FOMC rate decision. That's going to be a very big one, big week of data. It's going to be a very big week. So guys, if you want to keep up to date, go ahead, follow me on Twitter, subscribe. I break everything down every single day. And if you've made it up until here, thank you so much for watching, guys. Please subscribe, hit the like button, leave a comment. You know I love you guys.